The orange line is S&P 500. It hits higher throughout. There's a high, higher high, higher high, higher high, while the market breadth is pointing to a lower high. This is a high, that's a lower high, or even here, that's a lower high. That's a diverging scenario. It only shows that they are getting lesser and lesser stocks participate in this rally. Another thing I mentioned briefly earlier on is the oversold level. I consider 20 to 30 as the oversold level. If you get into the extreme oversold, below 20 or even below 10, that will be perfect. If you look at this chart, it works very well, especially the level 10. Hit that, and then it would have an automatic rally, a technical rally, because that's considered as oversold. Imagine that only 10% of the stocks are above the 20-day moving average. That's oversold. Whenever we have the situation, then most likely we are getting a rebound. Right now is at about 30. 30 is considered as approaching oversold. We want to see below 20. Below 20 will be a good level. Last time when we have a pullback in April, this market breadth dipped below 20. It's deep into this zone. That's the oversold zone. 16, only about 16% of the stocks above the 20-day MA. Subsequently, have a technical rebound and then go up. And we have the index follow up. Right now is approaching that level. Previously, we also have this close to 30 and then start to rebound. But that's a different context because at that time, S&P 500 is consolidating rather than charging to a new high. This is a diverging situation. There are two scenarios that I would like to discuss. The first is the bullish scenario. The bullish scenario is my preferred case, mainly because of the market structure and the overall supply level. If we look at the breadth, despite his having the divergence, means that there are lesser and lesser stocks participate, and only the heavyweights are charging up, we could still see the breadth improve. It means that we could still have the scenario where we have the breadth hit about 30, then starting to rebound, and then getting more and more stocks, while the heavyweights probably have pullback, consolidation, something like this. We will see the leaders like NVDA, Google, all the tech stocks, MU, ARM, the stocks probably consolidate or have a minor pullback, while the rest of the stocks catching up. That's possible. The bearish scenario is, this is a red flag because they are getting lesser and lesser stocks participate in this rally. Only the heavyweights are supporting the index. When we have a reversal in those heavyweights, such as NVDA, Apple, Amazon, Google, Netflix, those kind of stocks that you could think of, have heavy profit taking, have some huge bearish commitment bar, reverse to the downside, and then kickstart downswing, then the index would have a deep correction. I still prefer the bullish case, mainly because the supply level is relatively low at the moment. I don't really see a ton of the supply coming out. The other thing is the end of quarter effect. If you want to catch my latest videos, click on the subscribe button and the bell right now so that you get instant notification once I upload my latest video. If you want to check out my online courses, go to tradeprecise.com to find out how to profit consistently from any market without using complex indicator or understanding any financial statement, no matter you are trading or investing.